Hello everyone, welcome back to my YouTube channel. Today's video is going to be super interesting and super important for every person who want to understand credit risk scorecard models. So in scorecard modeling, there are various things which you should understand. There are so many type of scorecard models, and in banking, it is one of the highest paying career. If you want to work in scorecard and then you want to earn so much money, then this video is for you. So without wasting your time, let me take you forward, and today's video is going to be very long also. I would try to keep it in a precise way, maybe to 30 to 45 minutes, but just be with me till the end of this video and you will be fully clear with the concepts of scorecard model. So now without wasting your time, let me take you forward. Quickly, let's move on, guys. Okay, so all of you can see the whiteboard, right? And now let me change the topic first. So the topic for today is going to be credit scorecards. Okay. Now, before I go into the detail of the credit scorecard, many of you will not even know what is a scorecard, what is credit. Okay. So to understand that, the first thing which everybody should know, if you want to come to the background of credit scorecard, okay, it's a type of credit risk model. So what is a credit risk scorecard? Simply, it is a type of credit risk models which basically tells us whether the event will happen or not. Okay, so basically the output of this whole scorecard usually tells you that whether an event will happen or not, and mostly the event is, what is an event? Okay, so event is anything which is changing the status of the customer. What does that mean? If a customer is a bad customer or a customer is a good customer, so that is a bifurcation. Okay, that is an event that customer becomes delinquent. Okay, before we go into delinquency, what is delinquency? Just understand that the output of the credit scorecard tells you an event, whether the customer is a bad event, is a bad customer or a good customer, simply. So that is the output, and this talks more about the likelihood. So basically this tells us the probability that the customer will be defaulting or not. So that whole purpose here is to predict the probability. Okay. Now, if you see, so there are various type of scorecards do exist. So there are various type of scorecards. Various type of scorecard models. So there are 4 to 5 type of scorecard model usually which are highly used in the industry, and they have jobs. Okay, so if you see in any of the bank, there is a model development job. So this is all about the scorecard models. Okay, these are the most important type of model in your bank. Now let's go a bit down so that I can talk more. Okay, so now there are types. Okay, so I would tell you the first type here is your application scorecard. It's the application scorecard. Second type is behavior scorecard. Sorry about my handwriting, guys. Third one is your, so before going to the third one, let me give you a bit summary about first two, because these two are the most important one, and third and fourth actually are not that much of important. So let me talk about these. First one is your application scorecard. Application scorecard talks always about the new customer to the bank, new customers. So whenever a person is going to the bank, that person is known as a new customer. So this person, let's say the person name is A. So Mr. A is going to, let's say, SBI. Mr. A want to take a loan. He want to take a home loan. So when he go to the bank, when he fill the application form, he fills the information about himself. So bank will have now the application of the customer. So on the basis of the application, bank will do the calculation and it will decide two things. Okay, either loan will be granted, so loan will be yes, or there is a no. Third status sometime can be halt. So bank will put the application on halt and they will basically ask for more information from the customer so that they can do the either the rejection or the acceptance of the loan. Okay. So in this case, bank usually produce the application scorecard to make a judgment whether they should give the loan or not. That is known as an application scorecard. Number one, application scorecards are also known as one more name, and that is acquisition scorecard. Acquisition also. So application or acquisition is the same thing. It's performed on the new customer. Then you have the behavior scorecard number 2. Then you have third type of scorecard is your collection. Fourth is fraud. Collection scorecard and fraud scorecard. So this third and fourth are not that much important at the moment, because my past experience is if you work in a model development team in any of the credit risk or any of the banks like maybe Wells Fargo, JP Morgan, Citibank, whatever, HSBC, Standard Chartered. So you would be 90% will get a job where you need to work either on the application scorecard or on the behavior scorecard. I was the part of application and behavior scorecard when I was in Standard Chartered, and in my current company also I am leading. Actually now I am a manager of these teams who are producing application and behavior scorecard. Now before I go into the detail of third and fourth, let me talk about the second type, which is behavior scorecard. So now Mr. A got a loan. Okay, so Mr. A again got a loan and he purchased a house also. Now he has a house from that loan amount. He's paying EMI regularly to the bank. Now after 1 year, let's say, he's paying EMI for 1 year. After 1 year, bank will again do a assessment to calculate whether Mr. A can default in next 2 year or next 1 year or not. So that scorecard which we build after the customer is onboarded, and that is part of the system. After a certain period of time, you calculate whether the customer will default in a specific time frame or not. That is known as a behavior scorecard, because we are judging the behavior of the customer here. Simple. Okay. Now, collection scorecard and fraud scorecard, I will talk very much in brief because my focus is going to be application and behavior in this particular video. Now, collection scorecard is when a customer is not able to pay the money. So bank always have a collection team. They try to collect the money. They go to the person's house. They go to that person who has taken the loan and they will try to recover the money directly from the person. Fraud scorecard. This scorecard basically tells what is the likelihood that these customer will default as a fraud or not. But that is very less likely to have, because now bank is very stringent and bank do all these assessment very much in advance. So now let's roll it up again to the top 2 scorecard, which is your application, and then you have the fraud score, the behavior scorecard. So let's talk one by one. So from the, so I will write in short form, maybe let's say application. Let's talk about this first. So when you talk about the acquisition scorecard, so the step number 1 when you are building an acquisition scorecard is the process of underwriting. Okay. This is very important concept. When you are submitting your application to the bank, so the first thing bank will do the underwriting process. Okay. Application scorecard are usually used during the underwriting process. That is number 1. Application scorecard basically help to reach. It help to reach 3 status of loan. Either you will approve or you will reject, or third status is going to be your refer to senior. So after this underwriting process, when you are building the application scorecard, you will be receiving a status of for that particular customer, and that is going to be either the approval of the loan, either the rejection of the loan, or refer to the senior for much more detail, so that we will connect with the customer and we will get much more detail from that particular customer. Now this is step 1. Now step 2, application scorecard data, which we are using here to build the model. There are two type of data are used. Data are of two types. Number 1 is the in-house application data, which the customer has submitted application data. Number 2, which we buy from the external vendor, which we call bureau, data bureau. Example, in India, when we apply the loan, so bank usually check our CIBIL score. But in US, there are so many data bureau like Equifax, Experian, TransUnion, and so many others. So basically, bank use all of them to buy the data and do the assessment on their own level before giving you the loan as a customer. Okay. So these are the two important points which you need to remember about the application scorecard and mainly the underwriting process. So application scorecard is built during the underwriting process. That is number 1. Now let's move on to the second type. That is your behavior scorecard. Let me write in a short form. Now, in the case of behavior scorecard, data used, which we basically take as an input instead of only the application and bureau, we will have one more type of data as an input here. So let me make that point very much clear. Data of input is 3 type here. 3 type of data input will come here. Number 1 is application, which was there earlier also. Number 2 is bureau. Number 3, which is the new one, is your transactions. So in behavior scorecard, you have transactional data also. Application, you know, like about all the application, age, income, gender, married, non-married, employment status, all of that. Bureau will tell about the delinquency of the customer, what is the credit history of the customer. Then transaction data, as I give you the example of Mr. A who took the loan from SBI. So that transaction of 1 year when he was paying the EMI, that is known as a transactional data. Behavior scorecard is very important for existing portfolios. I'll tell you the meaning of portfolio. Existing portfolio customers. So basically, we make the behavior scorecard for the existing portfolio customer, and portfolio can be anything. It can be loan, it can be credit cards also, because people take loan from their credit card also. Now, so here is a use case. Okay, we'll talk about the use case obviously for the acquisition or the application scorecard. What is the use case? So all of you know, obviously on the basis of this whole picture, we are basically approving or rejecting the loan, which I already told you. Now, what is a use case for the behavior scorecard? This basically tells you, it helps you to identify the best customer. Number 1, use cases. Now, obviously, many of you will think, why we need to identify best customer? Wait, I'll tell you. Identify best customers. Number 2, which is very related, identify worst customers. Number 3, which bank is more interested, is cross-selling. Okay. So now what is the meaning of each of them? Let me tell you. Okay. So number 1, when I say that bank want to identify the best customer, bank want to know who are the best customer for them, means who are the always on time people. They are paying their EMI always on time and never missing anything ever. That is the best customer, and they will get to know who are those customers who have the highest balance. So they will be able to identify the richest customer from this. Richest customer. Now these worst customer, point 2, worst customer will tell you the bank that bank need to focus and prioritize these customer above the rest of the customer, because these are more likely to get default. So bank will not offer them other products. Bank will make sure that any upcoming product should not be given to these worst customer. And cross selling is what, this is the top most important part which bank is always interested. Let's say a customer is there who has a big loan and the person is maintaining a very good balance, very good reputation, always paying EMI on time. So bank will try to sell them credit card, obviously with some extra benefits. Bank will try to sell them FD, because that person has more money so they can buy these products. Bank will try to make them engage in more products, so they will assign a relationship manager and they will make sure. Bank will always tell the relationship manager that you have to sell something to these clients, which are the best set of customers at the moment. I hope this is making sense. As of now, everything is clear to all of you. Okay. Now let me talk about life cycle a bit. Topic which is more important before we go deep down and more further in terms of the overall steps. Now, life cycle of credit risk management. Guys, always remember this is going to be the life cycle. Obviously, these steps are further divided into much more deeper steps. So you need to understand the pulse of it with me in this video. Step number one is your planning. Always anything when you are building a model in a bank, it always starts with planning. All the regulatory body need to give the all information to the bank. Like let's say in India, RBI will give the correct guideline to SBI. Then SBI will start planning. Step one. Step two, acquisition of customer. So bank will try to acquire more and more customers. So for example, you might have seen SBI credit card people standing in all the malls. They are poaching you, they are running behind you to sell you credit card. That is known as acquisition. Okay. After the acquisition, some people will buy the product from the bank. Then bank will go into service mode. So bank will provide them the service, they will assign them a kind of a relationship manager, will give them all the benefits, interest and this and that. And after that whole life cycle, bank will go to the collection and recovery phase. Some people will not ever go to this criteria because they are paying everything on time, but some of the customer will go to the collection part. And after the collection is done, obviously there is always 1% chance that for some customer bank will not be able to do the collection. So the write-off phase will come. What is the meaning of write-off? Let's say Mr. A has taken a loan of 10 rupees. During his tenure of loan, he was able to, and okay, before I go there, one more thing I want to add. He took a loan of 10 rupees. Now, with interest, his loan becomes 12 rupees. So, Mr. A has paid already, let's say, 9 rupees. So, this 3 rupees was about to pay. But before that, his bankruptcy happened. He lost his whole business and now he don't have a money to pay. Now, bank will try to do the collection by going to him, selling his company, his machinery, everything. But still bank is thinking that out of this 3 rupees, I'm only able to receive 2. So still 1 rupee is pending after selling his company, assets, his everything. Now this 1 rupee will go to a write-off. And if you see 9 rupees came naturally, this 3 rupees was pending. Out of 3, 2 is known as a collection because bank collected it somehow. And then the final part is that 1 rupee will always go to the write-off because bank basically write off that 1 rupee. Now bank need to do the balancing from somewhere else and using their own product. So now just remember this life cycle. Okay, this is very important. Everybody should know it. It's very important from interview every perspective. Now let's get back. So I was talking about the scorecards obviously. So let me give you an example of how the template of an application scorecard looks like. Application template. So when you will make a scorecard, how it looks like. Obviously, many of you will think that Rajat, you are talking so much, but I want to see how it will look like. What will be the values in the scorecard model? On the basis of that, bank obviously take a call. Okay. Now this is a sample I am making here. So number one, you will have a column where you will have variables. Number two is you do the grouping. So you will call it groups. And the third column here is scores. Score of each customer. Now, before we go in deep down, there will be a baseline score. I'll tell you what is baseline score. Baseline score. So every bank decide that there is a baseline score, and what is the meaning of that? If any customer is having at least that much of score, so we can give them loan. At least if a customer is getting 723 out of 1000, then we will grant the loan. Okay. So this is how it should look like. Now this table will be there. This will be on the header. And this is baseline is there, and then these three columns. Now let me tell you what are the values will be there in these three columns. Let me complete the table. Okay. Now here we'll talk about variables like, let's say, x1, and what will be x1? Delinquency in last 90 months. Delinquency in last 90 days, not months. My bad. So bank will check that whether this customer was delinquent in last 90 days or not. Similarly, there will be another column x2. Let's say bank will test that whether the customer was delinquent within last 180 days or not. Similarly, after 180, it will check for 320 also. Okay. So these kind of variable will be there, which will talk about the performance of that particular customer and how they are able to achieve this with the help of bureau data and application data. Bureau data will give you all the important necessary delinquency columns, which I mentioned initially. Now, here all these columns will be there, and in the group, what will be there in the group column? So for each and every variable which is like delinquent in last 90 days, that means the customer has not paid the EMI in last 3 months. If a customer is there, so there will be scoring. So if a customer who has defaulted or maybe has not paid the money on the first month itself, there will be a different score. If a person is there who is not paying after 2 months, there will be a different score. If a person is there who is not paying after 3 months, that is a different score. So maybe 17% to 18% score for the people who defaulted in the first month. Then maybe 19% to 21% for the people who defaulted in the second month. Similarly, there will be grid. So there will be percentages in short. There will be structure of percentages in your second column, just like I said. And in the score, you will have a scores. So what will be there? Let's say in this particular column, X1, the person got 25 score. In column number 2, X2, which was a delinquency in, let's say, 180 days, the person got a score of 75. Now in the last, after doing all this, like there will be column X3, X4, similarly, so many, 5 to 6. In the end, what you will say, you will call it as a total score. And here in the end, you will take the total. So let's say the total is coming 629. So now this 629 is less than the baseline score. So you will reject loan. So that's how this whole structure works. Okay. Now this is an example of a real life scorecard. That's how the scorecard looks like in Excel file. So usually all the teams are making scorecard in Excel only, whether using Python or SAS. The output always comes in the Excel format. Okay. Now let's talk about in detail one more thing, very important thing. This is the core of this particular video which I'm making here. Now this is all about the application scorecard development methodology. So let me mention app scorecard development methodology. This is the most important thing. I'll tell you why. Because this methodology tells you about all the steps which are involved to make a scorecard model for any bank, and it's very important for all the banks. Okay, so just be very careful when I'm talking about this. Okay, now let's go one by one. So there are three things here. Okay, number one is steps, number two is process, number three is sub process. And I would like to request all of you to make notes here, because this is going to be very important. Okay, you should be making notes from this point of time in this video for sure. You should not miss this. Now, step one. What is step one talks about? You need to identify the data sources. The process will be called as a data source identify. So on step one, you will figure out what are the data sources which we are using here, and you need to make sure those are internal and external, like bank internal system also and the bureau data itself. So both the things should be there. So the sub process will be called here internal and external. What is internal? Bank's own data. Bank have the application data, they have the transaction data, everything they have, that is known as a internal data. External data is known as a bureau data, which bank purchase, and bank need to pay to the bureau for each and every variable. It's very expensive. Okay, it's not a cheap thing to buy. Every bank, even small bank, cannot purchase the data from these large data bureau, because they charge in millions also if you buy the huge number of data from them. Okay, this is your step number one, data source identification. Now step number two. Step number two is always about sampling and target variable creation. So data source you identified, now you will do the sampling and the target variable creation. Now sub process will be here. Number one is your target variable creation, which is nothing but your default and non-default indicator, that is known as your target variable. Because target is what? To predict the probability of default, right? Whether the person will default or not, that is known as a target variable. Second sub process will be here to calculate vintage analysis. Now what is vintage analysis? I will tell you further also, but just to understand for now, vintage analysis is a method to calculate the bad definition in a model, that is known as a vintage analysis, which actually tells you what is a bad definition of a customer. Now bad definition itself is a word to self define what is bad definition, right? So vintage analysis is a method to that. Now third sub process here will be sampling. What is sampling? I will tell you in detail. Now let's go a bit more down. Now let's talk about the step number three. So step number three here is, step number three will come here. I think things are clear to you, right? So it's pretty much visible. Now step number three is data preparation. So you will do the data preparation for your model. Okay, so for that, what will be the sub process? You will need to identify independent variables. What is independent variables? So your output, which is your default and non-default, is obviously a dependent variable depending on the credit history, application, and so other things. Independent variables are the variable which basically you use to calculate the default happen or not. All the important variables are known as independent variable in your model. Just remember this for now. Second thing will be exclusion criteria. That what are the type of observation you need to remove from the model. So you need to identify the exclusion when you are preparing the data. It's nothing, it's exploratory data analysis also. This data preparation steps is also known as exploratory data analysis. So you'll do the exclusion, then you will do the missing value treatment. You will check the missing values. Then you will check the outliers. In your data, if you have any outliers, this is very weird, but bear with me. My handwriting is not good here, maybe. So the outlier detection is the next step here, okay? And then the final step here will be weight of evidence transformation. Now, what is weight of evidence? Let me tell you that. So guys, exclusion is clear, missing value everybody knows, okay? Now outlier, what is an outlier? Let's say in a data, there are all the people who have age up to 30 years. Suddenly one person I see in that data, the age is 47. So that is an outlier. Something which is unusual in the data is always known as an outlier. Now what is weight of evidence? So weight of evidence always talks about what is the importance of this particular variable. That is known as weight of evidence of this particular variable. What is the weight? How much weightage this variable have in terms of showing the output correctly? That is known as weight of evidence transformation here. Okay. So this was the all third step. Now let's talk about the step number 4. Step number 4 in your model building process. That is known as a segmentation. So now you have the data prepared, okay? So you have everything in place. Now segmentation will come. So segmentation, you need to understand basically that which approach you are going to take, like logistic regression, linear regression, random forest, or whatsoever. So are you going to use a judgmental approach here, or are you going to use a statistical, stat based? So you can simply say example can be like logistic regression or maybe random forest. So this is your step number 4. Okay. Now let's talk about step number 5. Step number 4 is pretty easy. Okay. So if you have a right set of understanding in terms of a model developer, you will be able to achieve this. Okay. Okay. Before I go to next step, let's summarize. We identify the resources, okay, internal, external, then we did the sampling, then we did the data preparation, then we identify the approach known as segmentation. Now next step here is going to be variable reduction. Variable reduction. This is again very important because keeping unnecessary variables in your data always increase the size of your data. So you need to make sure all the important regulatory exclusion are done. Regulatory exclusion. Now what is regulatory exclusion? Let's say in India we have RBI. So RBI will say some guideline to SBI that remove this type of people from your data. For example, who are deceased. Let's say all the customer who have deceased, so don't, and they have a widow, okay, which is non-working. So this is a exclusion. How bank will recover a money? Let's say a person die and his wife is non-working. How you will recover the money? You will not sell her house, right? You will not put her on the road. So obviously those kind of exclusions are always part of the data. Then you need to identify the second sub process is going to be the information value. Information value talks about how much information a single variable is giving and what is the weightage. Like weight of evidence and information values are very similar in terms of giving you the weightage of the importance of the variable, that this is the importance of the variable, you need to use it. Then the next sub process is going to be weight of evidence trend check. I already explained the weight of evidence trend, and then here you will check the multi-collinearity. Multi-collinearity. Now many of you will not know multi-collinearity. What is multi-collinearity? I'll tell you. So if there are two variables which are basically conveying the same meaning or not. Let's say if I talk about marriage, there are two columns in the data. One is marriage status, one is some other, but conveying the same meaning. For example, yearly income and monthly income. Both are like quite correlated to each other. Let's say if you have a monthly income of the customer, you can easily identify the yearly income, right? So both those columns, if you keep in the data, it is giving not much sense. Okay. Similarly, if you put any variable which is talking about maybe EMI payment and then total payment, So sometime it happens, guys. Multicollinearity means basically if you have two variables which are trying to convey the same meaning in your data, that is known as multicollinearity problem. So you should always solve this, and before making the model, you should always identify those columns which are correlated with each other. So that is multicollinearity. This is your step number. This was your step number 5. Now let's talk about step number 6. This is the model creation part. Now everything we have done, exclusion, everything is done. Now this is model creation. In model creation, what are the sub process? In model creation, you will do the training. So you created a model, you do the training of the model by providing the data which is there in the bank. So that is known as a model training. Then you will check the benefit of weight of evidence. And in this course, don't worry guys, I will tell you all of this much more in detail, how you calculate weight of evidence, everything you'll get to know slowly. Now weight of evidence is something which we will do here, and then we'll do the reject inference. So obviously there are results which we will accept. There will be, we will do the challenge to our model. We challenge the data which we provided so that we can be more sure from model validation perspective that the data which we are using here is fully validated or not. This is your step number 6. Now let's go to step number 7. That is score calibration. Score calibration. So bank always makes sure that the score calibration is done. So for that, the step number 1 is log of odds. You calculate log of odds calculations. So you calculate the odd scenario, like let's say COVID is an odd scenario. Let's say Great Depression, it's an odd scenario. Okay, so you do all of that. Now the next step here is calculate scorecard points. Pretty much understandable. For each weight of evidence attribute. So you calculate the scorecard point for each weight of evidence attribute. I showed you the sample also in the starting itself. This is your step number 8. Now it comes the step number this was step number 7. Now comes the step number 8, which is the last step, which is your model validation. Model validation. Now in the model validation, you have everything ready. You have the prediction also done. At this step when you reach, so you have everything sorted at the moment. Now you are performing some model validation so that as a model developer, when you will hand over this whole code to some model validation team, they should have all those metrics at their place. That's why model developers are paid highest, because they are doing the most of the work. Okay, so how you do the model validation? I'll tell you specific metrics. So you calculate Gini coefficient. Okay. Then you do the AR calculation. Okay. Then you do the KS. Then you do rank ordering. All of them are individual topics which I will teach you in this course. Don't worry. Then you will have the PSI. Stability index, we call it. Population stability index. Okay. Then we calculate concordance, discordance. These are itself good topics, and then you calculate sometime Somers D multiplier. Okay, then you calculate HL stats. This is one more important validation criteria. Then you do the score concentration. So these are all the steps which are involved in making a application scorecard. This is a very important video, guys. All of you, I will again take you through the overall process here. So revision, obviously you can do at your end, and if you need any help, so you let me know. But if you see here, this is the most important part. Application scorecard development methodology. Process talks about identify data sources, then sampling, target variable creation, then data preparation or EDA in other language. Then you'll have the segmentation, basically deciding the approach you are going to use. Then variable reduction. So you need to keep only variables which are meaningful here. Then model creation, score calibration, self-explanatory, then model validation. Model validation is again a very important topic because in many company people work specifically in model validation. I do have teams for model development and model validation both. So both the people are working under me. I have like close to 15 people. Okay. Nevertheless, on that note, I would like to conclude this video today, and I hope you like the video. If you guys found this video helpful, please subscribe to my YouTube channel, please hit the like button, and please do comment, guys. If you don't comment, I actually don't feel much motivated. Your comments actually work as a fuel for my motivation. So if you do some comment, I always reply to that. If you like the video, please share this video with your friends, your colleagues also, so that they can also learn. On that note, I would like to take a bye from all of you for today, but I will make sure I will come back with much more impactful content in next video. Thank you so much. All the best. Please subscribe. Thank you guys. Bye.